Concept Academy. Today we'll be looking at illustrations where one of the partners is insolvent, one of the partners is nowhere to be found. In that scenario, remember we said we'll be looking at Garner versus Murray. We use Garner versus Murray approach to share the insolvency of the partner. Now, when we come to this, looking at this question, as we can see on the screen, we can see that A, B, and C were in partners, sharing profit and loss equally. In this scenario, 3 persons are in business. An examiner says that these 3 persons are sharing the profit or loss equally. They found that the competition from all modern firms, or they found that this competition from the question, the examiner says that the competitions became too much, and they decided to liquidate the business. First thing most, these partners, they are sharing profit or loss equally. Now, since this has happened, look at it. They say the following is their statement of financial position as at 31st December 2018. Look at their assets. Now, the asset, goodwill 2,000, premises 6,600, plant and equipment 4,100. Investments 2,160, inventory and all. Now, very important thing I want you to look at in this question is, if you look at the debit side of the trial balance, you will look at that. When you come to current account balance, you see that C's current account is in bracket, which means that C is the partner that is deficient. So what do we do in this scenario? First of all, the examiner says we should prepare our realization account. From the first one, just as we did, all the assets that the business have been using in business. So quickly, you say realization account. So in your realization account, first and foremost, all the assets the business is using for business, they will be what? Debited. What do we do? Remember, if the examiner has asked us for asset account, all you need to do is open asset account, then you credit realization account. So what do we do? Quickly, all the assets that the business have been using in business, we open account for them. Now remember, the first step, you go to the illustration to see what the examiner is talking about. Now what do we do? First thing here is goodwill. Goodwill, the examiner says that goodwill is 2,000 according to the examiner. And the examiner told us that premises that the business has been using, that if they want to sell it, premises is 6,600. As you can see the question on the board, investment, plant and machinery. Examiner says that plant and machinery, or using plant and machinery, examiner says plant and machinery from the question is 4,100. The examiner says that inventory, our inventory is 2,000, inventory is 1,900. Examiner says investment is 2,160. Okay, then cost of dissolution. Like I told you, the only item that always comes from the additional information is cost of dissolution and interest on loan. Cost of dissolution from the question is 100. Debtors, those that are owing the business. From the question, we can see debtors is 3,240. Then interest on loan. Examiner says interest on loan is 240. How do we get this 240? Examiner says it is 8%. 8 over 100. Look at the question. We can see that 8 over 100, the amount for loan is, from the question, loan is 3,000. So 8% of 3,000 will give us 240. That's how we are getting to the 240. Now, having done this, we now pick all the items on the additional information that constitute both the ones the partners are taking over and both the ones that were realized. We'll take them to the credit side. Okay, now we come over here. We say sales proceed. What are the assets that they sold? The asset that they sold, one of the assets that they sold here is investment. Their investment, they sold the investment. According to them, the investment cost They sold the investment for 2,840. Then the next thing here is debtors. How much was debtors sold? Debtors was sold 3,000. The next thing that was sold here, or the asset taken over, partners took over asset. Asset taken over. They told us from the question that B took over plant and equipment, plant and machinery, and they told us that B took this plant and equipment at valuation of 3,700. The examiner went ahead to tell us that A took over premises, and that this A took over this premises at a valuation price of 700. Then this same A took over inventory. Now the examiner says that A took over inventory at book value less 10% discount. The book value, the cost of this inventory is 1,900. Inventory is cost 1,900, but we are giving it to A at this 1,900 times 10 over 100. This, if you do 10% of that, you have 190. So A took over one. We are giving A discount of what? 190. So 1,900, which is the cost, minus 190. So A is giving us 1,710. So A is paying us 1,710. Remember, this inventory is cost 19, and A is giving us 1,710. So we A 1,710. But before you close this, you now ask yourself, is there discount from customer? And we can always know discount from customer from creditors. The illustration told us that the business we are owing 4,000 naira to the creditors. If you look at this, creditors are 4,000 naira, but are telling us that these creditors were settled in full, less 5% discount. So if we are owing 4,000 times 5 over 100, this is going to give us 200. Meaning that these creditors, 4,000, we are going to minus that discount of 200. What we actually pay to creditors is 3,800. I repeat this situation, that we are paying creditors less 5% discount, and this amount is going to constitute revenue to the business. What do? We say 4,000 times 5 over 100, which will give us 200. This is our discount, and it will come in our realization. So we call it discount, which is 200. Now, what do? You add your debit side and add your credit side to know the difference. Now, if you add the debit side, you see that the debit side is greater. The debit side here is giving us 20,340, which is the total value which we are going to use to close our account. Now, the difference between the debit side and the credit side is 1,890. So that 1,890 is lost. We share it among them. So 1,890 divided by 3 persons. So A will have 630, B will have 630, C will have 630. In this scenario, what the partners are sharing is loss. Having done that, remember, first thing most, look at what they are asked. They asked us to prepare realization accounts, which we do it quickly. Now, the other thing examiner says we should do is partners capital accounts. Now, remember, these partners took over assets. B took over plant and equipment, and B is giving us 37. A took over premises at a valuation of what? 700. And A still took over inventory, but A did not pay us the full amount. We gave A 10% discount. Okay, having done that, the next thing here is to calculate my capital account. So all I will do is I will say partners capital account. This is for A, this is for B, and this is for C. This is column for particulars A, B, and C. So here is particulars. Here is for A, B, and C. Particulars A, B, and C. So when you have something like this, first thing foremost here is, since we are talking about partners capital account, what do? You bring down the capital balance. How much did this person using to start up this business? So from the question, balance brought down. So from the question, we can see that A contributed 9,000, B contributed 4,500, and from the question we can see that C contributed 2,300. Okay, when you have something like this, what next? What do they have in current account? What is their current account balance? This is actually a place to determine which partner is solvent and partner that is not solvent. Okay, so what we say current account balance, current balance. Okay, their current balance brought down, we could see that A has 500, C has 900, but this does not have this has a negative current balance. So since it has a negative current balance, the balance comes here, balance brought down, which is 2,000. This is that deficiency. Now remember I told you in the former calculation that if it was share of profit, which should have been on the debit side, it will be credited here. But here is share of loss. So share of loss, each of them got 630, 630, and 630. Now the next thing here is, did anybody take over assets? Remember on our format, assets taking over. From the question, it told us that P and plant and equipment, that B took it over at a valuation of 3,700. That A took over premises. A took over premises at a valuation of 700. The same A took over inventory at a valuation of 1,710. So it is time to add. So if you add the debit side of A here, the credit side of A here is giving me 9,500, which is actually the highest, 9,500. And here is 9,500. The difference between it is balance carried down of 60. So if you add this side and this, the debit side is, the credit side is greater than the debit side, 160. So if you add it, you will see that the A of this side is greater. So the difference between the sum of this side and the sum of this side constitute balance carried down. Then the same thing applies in the other B. B is 5,400. If you add 4,500 plus 900 is 5,400. We'll close with 5,400 and the difference is 1,070. But when it comes to C, this is 2,630. 2,630, which is the higher value, 2,630. The difference is balance carried down, which is what? 330. This 330 is the deficiency that we are going to share among the partners. This 330 will be shared among the partners. So how do we share it? We use Garner versus Murray approach. Quickly, what do? You still open Garner versus Murray account, Garner versus Murray. The essence of this account is to share the liabilities between the partners who are still in business. Okay, here is particulars. Here is A, here is B, here is C, here is particulars, here is A, here is B, and here is C. So let us bring the balances down. Look at this. The balances of these persons are on the debit side. The corresponding balance will be on the what? Credit side. So we say balance brought down. So A has 160, 1,710, and here is what? Dash. Now look at where the balance carried down of this. So the balance carried down of C is on the credit side. The corresponding balance is on the debit side. We'll say balance brought down, which is 330. So we share it. So we are going to share this 330, share of loss. So let's share it. There are 3 persons in business, A, B, and C. They are supposed to have 3:2:1. But this guy is no longer available. How many persons are now remaining in business? 2. And we are going to share loss of what? 330. And this loss is what? 330. So if I want to share this, I'm going to have 2/3 times 330. 1/, that is for A, and this is for B. 1/3 times 330. Because there have been 3 in business and 2 persons, 1 person is no longer available. So if you do that, this will give me equal to 220, and this will give me equal to 110. If you add these 2 things, you will have 330. So A is going to have 220, B is going to have 110. So let us balance our accounts. Now, how do we balance our accounts? We'll come here. 220 and this is greater, so we'll have 220 as a higher value. So we are going to close account with A of here, 220. What is the difference between 220 and 160? So our balance carried down is going to be 60. 1070 is greater, so we'll close our account with 1070. And what is different between 1070? Our balance carried down will be here, which is 960. So the same thing applies here. We'll write 330 here. We are not, this one did not get the portion, 330 and 330, so that our account can close. We have been able to use Garner versus Mori approach to share it. First of all, after a capital account, look at where this balance carried down is, showing that C is deficient, and that is the amount we are what? Sharing. So what do we do now? Having done this, we are going to create our cash or bank account. So to know if our account is balanced. If our cash or bank account is not balanced, we must trace error. So what do we do here? To create our cash or bank account, you come here and say cash account. From the question, the first thing you bring down is your cash balance. From that question, balance brought down. The examiner gave us on the question that cash balance is 2,200 and assets sold. All the assets sold, they sold the investment. An examiner said that investment was sold, and this investment was for 2,840. And the examiner told us that we sold debtors, and debtors we sold it for 3,000. Now, what in again come? Let's bring their balances. Look at C. The balance of A is on the credit side, so the capital balance, capital account. So we are bringing A here. A is 60. Now, the same thing applies. The first thing come here, cost of dissolution. I've already given us the format. Dissolution, which is 100 naira. Creditors paid. We were owing creditors 4,000. They gave us discount of 400. It simply means we paid 3,800. Interest on loan 240. Loan 3,000. Capital account for B. Capital account for B, look at where B is, 960. If you add up this, cast this, it is expected to give us 8,100. 8,100. If here does not balance, you are wrong. Remember, first thing most, go to the question, know what the examiner is asking. Once you've got what the examiner is asking, what do? You know if there's a partner that is insolvent. If a partner is insolvent, you have Garner versus Mori to share the liability by the partners that are available. If there are 3 persons, 1 is off, most times they share this liability using capital contribution. You will still get the same answer. So remember, this is cash or bank account, which is expected to balance to show us that what we are actually doing is correct. So if you cash this, first thing, cost of dissolution, creditors paid. Remember, this is the amount we paid to creditors. We were owing them 4,000 and we paid, and they gave us discount, which was a realization account. Okay, that is it. Look at it. Take your time. First thing most, realization, dissolution, create a realization account, share the profit or loss, get their capital balance, and get their cash or bank balances. Thank you. On this note, this is the end of this section. See you on the next section. Thank you.